Welcome to the Pro Ticker Deep Dive.
It's great to be here.
So I want you to set the scene for a moment. Just picture this. It's a Tuesday morning.
Right.
It's February 3rd, 2026. You're waking up, you grab your coffee. Maybe it's a dark roast because, let's face it, you probably didn't sleep well. You open your trading terminal and you just see red.
And not just a little red.
No, I mean the kind of red that makes you check if your monitor is actually broken. That deep blood red color everywhere.
It was described as a historic seizure. And I think that's really the only way to put it. The market just froze and then collapsed.
Exactly. We are talking about the software sector specifically.
Yeah.
In just about 48 hours, starting on that Tuesday, something like, what was the final number? Around $285 billion to $300 billion in market value just vanished.
Evaporated. Poof.
Gone.
And to put a number like that in perspective for you listening, that is roughly the entire gross domestic product of a country like Finland.
A whole country's economy.
A whole country's economy wiped off the books for software, financial services, and asset management stocks in, what, 2 trading sessions?
It's unbelievable. And the atmosphere, I mean, reading the reports and the retrospectives, the mood on the trading floors was pure, uncut panic.
Oh, absolutely. It was a get-me-out mentality.
A get-me-out at any price mentality. Traders were dumping anything, and I really mean anything, that had a whiff of professional services, legal data, workflow tools.
If it looked like a SaaS dashboard, they sold it.
They sold it, no questions asked. It was totally indiscriminate.
Which is strange, because usually when you see a sell-off that's so aggressive, so widespread, it's tied to some massive macroeconomic event.
Right. The Fed announces a surprise rate hike, or a war breaks out, or, a global pandemic hit, something huge.
But this wasn't macro. This was something much more specific. The trigger was a product launch.
A single product launch. And that is where this whole story really begins, because this wasn't just any launch. This was what the headlines immediately started calling the SaaS apocalypse.
A bit dramatic, but maybe not wrong.
And the company behind it, Anthropic, the product, something called Claude Cowork.
The shot heard around the digital world.
So, okay, let's unpack this right here, because this is the central question. We've been living with AI for years now. We had the whole ChatGPT explosion back in 22, 23. We've seen the image generators, the coding assistants, the co-pilots.
It's been parse background noise for a while.
Exactly. So why did this specific piece of software cause a $300 billion market meltdown? What was so different about that Tuesday morning?
I think it boils down to a fundamental psychological shift in how the market defines AI.
A psychological shift.
Yeah. Up until February 2026, the market, and I think most of us, viewed AI as a co-pilot.
Right.
It was an assistant.
It helps you write an email faster.
Right. Or it summarizes a meeting you showed up late to.
Yeah.
It was useful, sure, but the human was always in the driver's seat. The human was the user, and the AI was the tool.
And Claude Cowork flipped that dynamic on its head.
Completely. Claude Cowork, and really it was the 11 new plugins they released alongside it for legal, sales, and marketing. It moved the needle from assistant to agentic.
Agentic AI. There it is. That's the term that's everywhere now. The buzzword of the month, maybe the buzzword of the decade?
It is, but it's so much more than a buzzword. It's a real functional leap.
Okay, define that for us. What does agentic actually mean in practice?
It means the AI has agency. Unlike the old models that would just sit there, with a blinking cursor waiting for you to type a prompt.
Waiting for an order.
Exactly. This new system, it can plan. It can execute a multi-step process. And this is the most critical part, it can finish a task from start to finish, autonomously.
Okay, give me a real-world example, because finishing tasks sounds great, but what are we talking about here?
All right, let's take a simple legal workflow, contract review.
Okay.
In the old world, and by old world I mean, a few weeks ago in January 2026, a junior lawyer might use an AI tool to help them. The tool would maybe highlight some risky clauses or find relevant precedent.
But the lawyer is still doing the actual work.
The lawyer is the engine. They're clicking through the document, they're reading, they're using their judgment, making decisions, typing out the comments, saving the file, emailing it to the partner. It's human-led.
The software is just a smarter version of Microsoft Word's spell check.
A perfect analogy.
Yeah.
Now, enter Claude Cowork. You don't ask it to just highlight clauses. Your prompt is something much bigger. It's handle the NDA triage for all new clients in the Western region this week.
That's a much bigger ask.
It's a job description, and Claude Cowork doesn't just highlight things. It accesses the secure file server, it ingests the new NDAs, it runs the compliance checks against your company's internal legal playbook, it flags deviations, it drafts the response
It
email,
organizes the folders.
it organizes the folders. It acts as a genuine coworker. It doesn't need constant hand-holding. It just does the job.
And that right there is the piece that terrified Wall Street.
Absolutely.
Because if the AI is the coworker,
Then you suddenly don't need quite as many human coworkers. And crucially for the stock market, if you don't need the human coworkers, you definitely don't need to pay for the expensive software licenses that those humans use.
and this is where we can draw a straight line from that product demo to the stock charts we saw just bleeding out.
A direct line.
You saw companies like LegalZoom, Thomson Reuters, RELX. They were down, what, 15, 17% in a single day?
Catastrophic drops. And then the bigger players, the behemoths like Salesforce and Adobe, they were also hammered, down 6, 7, 8%.
Let's stick with the legal example. A company like Thomson Reuters or RELX, which owns LexisNexis, their entire business model for decades has been built on selling access to data and specialized tools to lawyers.
It's human lawyers.
To human lawyers. So if an AI agent can bypass the human, go straight to the raw data, perform the analysis, and produce the finished legal brief, why do you need the expensive user interface?
You don't. Why do you need the dashboard that costs you $50,000 a year?
You don't. It's the middleman crisis.
That's it, precisely. The market suddenly woke up and realized that all these CRO'd apps.
CRRD, for our listeners, that's create, read, update, delete.
Right. It's basically a fancy term for any application that's just a pretty face on top of a database. And the fear is that these apps are becoming obsolete.
If I can just speak to my AI in plain English and say, handle this lawsuit, and it does it, I don't need to log into some complex legal software suite with a million buttons.
You don't need to learn the UI. You don't need a 3-day training course. You just need the result.
And this ties into another term that was popping up in all the analyst notes, vibe coding.
I love that term.
It sounds kind of fun, but for these SaaS companies, it's an existential threat.
It really is. It's the idea that an enterprise, a regular company, can now simply describe the tool they need in plain English. They describe the vibe of the software they want. And the Agentic AI just builds a bespoke internal tool to do it.
So wait, instead of going out and buying a massive multi-million-dollar Salesforce license just to track a specific type of client interaction,
You just turn to your enterprise AI and say,
hey, build me a simple tracker for these 10 clients. Make the interface look clean, and I don't know, send me an email if they ghost us for more than a week.
and it's just done. The AI spits out a functional, secure, internal web app that does exactly that one thing. And it completely bypasses the vendor.
That is the vibe coding threat. It's the democratization of software creation to the point where the vendor just becomes unnecessary.
You're not buying the software anymore. You're generating it on the fly, as needed.
Which brings us to the business model itself. This is the second major piece of the puzzle here. We have the trigger, which was Claude Cowork. Now we have the crisis, the death of the seat.
This is the core of it. This is the math that caused the panic. This is why all the spreadsheets on Wall Street suddenly flashed red.
So for the last, 15 years? Since the dawn of the cloud, really, the holy grail of tech revenue has been the per-seat license.
The COBOL's 1.0. It was the golden goose. You charge a company a recurring subscription fee, monthly or annually, for every single human employee who uses your software.
It's a beautiful model. It's predictable. Investors adore it.
Of course they do. If a company is growing, they hire more people. When they hire more people, you sell more seats. Your revenue grows right alongside your customer success. It's a simple linear relationship.
But the problem, the thing everyone realized on that Tuesday, is that agentic AI shatters that relationship. It breaks the correlation between a company's productivity and your software revenue.
It completely decouples them.
So walk me through the math on that. Break it down for us.
Okay, let's imagine a common scenario. An enterprise has a team of, say, 10 junior analysts.
Okay, 10 people.
And you, the software vendor, sell them 10 licenses of your fancy analytics tool. Let's say it's $100 a month for each license.
So that's $1,000 a month in recurring revenue for the vendor. 12 grand a year. Simple.
Simple, predictable. Now the company introduces an AI agent, something like Claude Cowork. And suddenly they realize that one human manager can now oversee a team of 10 AI agents that do all the work those junior analysts used to do.
So the company reassigns those 10 junior analysts to other roles where they don't need that specific tool. Or they just let them go.
Right. So now, how many software licenses does that company need from you for that department?
Just one. For the manager.
Exactly. So your revenue, the vendor's revenue, just dropped from $1,000 a month to $100 a month, a 90% revenue crash.
Wow.
But, and this is the absolute kicker, the company itself is actually more productive. They're getting the same amount of work done, probably faster, and with fewer errors, with a fraction of the human headcount.
That is the efficiency collapse. That's the term the bear started using.
That's it. It's this terrifying paradox where creating hyper-efficiency for your customer is actually catastrophic for your own revenue model.
Right.
The better your AI gets at replacing human work, the faster your per-seat revenue dives.
And the most bearish analysts were arguing that this could lead to IT budgets being slashed by, what, 70%?
70% was the number being thrown around. The idea that companies would just abandon these massive, expensive software suites in favor of cheap, bespoke AI tools or just fewer people.
So that's a truly terrifying prospect if you're a CEO or a shareholder of one of these legacy SaaS giants.
An existential threat.
So what do? How do these companies survive? They can't just sit there and watch their revenue evaporate. They have to pivot.
They have to pivot, and they have to do it fast, and we're already seeing the scramble. They have to move from selling access to selling results.
Outcome-based pricing.
That's the new buzzword. You have to stop charging for the user and start charging for the job done.
So give me an example. What does that look like?
Instead of charging a customer support department $50 a month for every agent using your platform,
Yeah.
you charge them $50 for every successfully resolved customer ticket.
I see. Or for the legal software, instead of charging per lawyer, you charge per completed legal review.
Exactly. Or per contract drafted. It actually aligns your incentives with the customers. You only make money when they get valuable work done.
On the surface, that sounds, it sounds really logical. It makes a ton of sense.
It's perfectly logical, but the market absolutely hates it right now.
Why? If it's the obvious solution, why the continued panic?
Because it's volatile. It scares the investors who've been trained for 15 years to love the beautiful stability of that flat monthly fee that hits the bank account every month, rain or shine.
Right. That predictable subscription revenue is so easy to model out for the next 5 years.
And outcome-based revenue is messy. What if your customer has a slow month for sales? Your revenue drops. What if the AI becomes so efficient that it can resolve a support ticket for a fraction of a cent? How do you price that?
It introduces uncertainty. And if there's one thing the market hates more than bad news, it's uncertainty.
You can price in bad news. You can build a model around it. You can't price in, we fundamentally don't know how our business is going to make money anymore.
Is anyone getting this right? Is there a company that's navigating this transition well?
There is one major exception. One company that seems to be surfing this wave while everyone else is getting crushed by it, and that's Palantir.
Ah, of course, Palantir. They always seem to be playing a different game.
They really do. They reported their earnings right in the middle of this whole SaaS apocalypse, and the stock popped. I think it was up 5%, while the rest of the sector was in a tailspin.
How are they doing it?
Because they've been doing this all along. Their whole model is already outcome-based. Their artificial intelligence platform, AIP, is used for logistics, for supply chain optimization, for military defense. They aren't selling seats. They're selling operational dominance. They're selling a result.
So they're demonstrating that it can be done.
They're the proof of concept. But for the legacy players, the Salesforces, the Adobes, the ServiceNows, turning that massive ship around, that's going to be incredibly difficult and painful.
Okay, so that's the bear case. And I have to say, it's a really, really strong one. The efficiency collapse, the death of the per-seat model, vibe coding, eating everyone's lunch, it feels pretty bleak.
The compelling argument for doom.
But not everyone agrees there's another side to this.
No, and this brings us to the counter-narrative. Because whenever you see this level of panic, there's always a group of people on the other side of the trade saying, wait a minute, you're missing the bigger picture.
And leading that charge right now is Dan Ives.
Dan Ives from Wedbush. He has become the loudest voice for the bulls in this whole debate. And his argument is essentially that everyone is panicking about a ghost.
Fighting a ghost. That was the exact quote from his note that just stuck with me.
Yeah, his thesis is that this is a 1995 moment, not a 1999 bubble.
Unpack that for us. What's the difference?
1999 was the end of a cycle, the bubble bursting, hype outstripping reality. 1995 was the very beginning of the consumer internet. It was the dawn of a new era.
So he's saying we're at the start of something huge, not the end.
Exactly. He thinks we're at the very, very beginning of the consumer AI revolution. The market is panicking about a worst-case scenario, the total and immediate obsolescence of all software that simply hasn't shown up in the actual data yet.
But hold on, the stock price has crashed? That's data, isn't it?
That's sentiment. That's emotion. That's fear. Ives' point is that if you look at the fundamentals, the enterprise reality is far more complex. He's calling companies like Microsoft, Oracle, CrowdStrike, table-pounding buys right now.
So he's actively telling people to buy into this dip.
He is. And his core argument is what I'd call the scaffolding theory.
The scaffolding theory, I like that. It implies structure, stability.
Think about it from the perspective of a Fortune 500 company, a massive bank, a global pharmaceutical company, a government agency.
Right, organizations with immense complexity.
Immense complexity. They have incredibly strict compliance needs. They have data sovereignty laws they have to follow. They have layers upon layers of security protocols built up over decades. They cannot just throw all that away and run their entire business on some homegrown scripts that an AI generated overnight.
Yeah, you can't just tell Claude Cowork, hey, build me a global investment bank and, hope for the best. Hope it complies with SEC regulations and anti-money laundering laws.
It's absurd when you think about it that way. That complexity is their moat. These large companies need the scaffolding of enterprise software. They need the governance that a platform like Salesforce provides. They need the security that CrowdStrike provides.
So Ives is arguing that the AI doesn't actually replace these tools.
It runs on top of them. The AI is the brain, but it needs a body. It needs a structure to operate within. It needs a safe, compliant environment to access data and execute tasks.
And that structure is the enterprise software. The AI needs a place to live.
Precisely. And he and other analysts, like the team at Jefferies, are pointing to a specific metric that investors are now flocking to. It's called the Rule of 40.
The Rule of 40. Okay, break that down for the listeners who might not be staring at a Bloomberg terminal all day.
It's a classic, quick and dirty metric for evaluating the health of a software company. Take its revenue growth rate, and you add its profit margin.
Okay.
If those two numbers added together equal 40 or more, you're considered a healthy, elite company.
So, for example, if you're growing at 25% a year and you have a 15% profit margin, you hit the Rule of 40.
You're golden. And what we're seeing is a massive rotation in the market. Investors are fleeing the growth at all costs, companies, the ones that burn tons of cash just to acquire users, and they're piling into the high-profit, high-growth names that meet this rule. Companies like Microsoft, Palantir, Oracle.
So the argument is this isn't the death of all software. It's a culling. The weak are going to die.
Yes. The simple to-do list apps, the basic project trackers, vibe coding will probably eat them for lunch.
But the companies that provide the essential, compliant, secure infrastructure, they're going to get even stronger because the AI needs them to function.
That's the bull case. The sell-off was emotional. It was a panic based on fear of the unknown. But the fundamental reality of enterprise IT hasn't actually changed overnight. You still need a system of record. You still need security.
And speaking of security, that's the perfect transition, because this brings us to what might be the single biggest news story of the month. While everyone else was frantically selling software stocks, one company made a massive, massive bet.
$25 billion bet.
The acquisition of CyberArk by Palo Alto Networks.
It's a monster deal, the largest in the entire history of the cybersecurity industry.
And the timing is just incredible. It happened right in the middle of all this chaos.
It's monumental. And it's a giant flashing neon sign that tells us exactly where the smart money thinks the future is heading. This wasn't just a purchase. It was a strategic realignment of the entire security landscape.
So, okay, let's get into that. Why CyberArk? And why right now?
It all comes down to two words: identity fortress.
An identity fortress. Okay, break that concept down for me.
For the last 30 years, cybersecurity has mostly been about protecting the network. You built a firewall. The model was a castle and a moat.
You kept the bad guys out. You monitored the perimeter, the walls of the castle.
Right, and if you were a trusted user inside the building, inside the network, you were generally considered safe. But that model is dead.
Why?
First, remote work blew 1,000 holes in the castle walls. But now, with agentic AI, the entire concept of a network perimeter is gone. It doesn't exist anymore. The only control point you have left is identity.
Who is logging in?
Or, more importantly, what is logging in?
The AI agents.
The AI agents. And this is the statistic that just completely blew my mind when I first saw it. In most large enterprises today, machine and AI agent identities now outnumber human identities by a factor of 80 to 1.
80 to 1. So for every single employee walking the halls, there are 80 bots, scripts, agents, and other non-human identities running around the digital systems.
That's right. And we're not talking about dumb bots that just ping a server. We're talking about agents with what's called privileged access.
Meaning they have the keys to the kingdom.
They hold the highest level of credentials. They can move money between accounts. They can read the most sensitive customer files. They can execute and deploy new code. They are running the business.
That sounds like an absolute security nightmare waiting to happen.
It is the single biggest nightmare for every CISO on the planet right now. Because if one of those agents is hijacked by a hacker, your firewall isn't going to stop it. Why would it?
Because it looks like a legitimate user. It's already inside the castle. It has the correct credentials, the right security badge.
It's the ultimate insider threat.
Mm-hmm.
So Palo Alto buying CyberArk is about building a system to secure all those digital badges.
The identity fortress.
Exactly. It's about a capability called real-time privilege revocation. It's a bit of a technical term, but the easiest way to think about it is as a kill switch.
A kill switch. I like that. It sounds very dramatic.
It is dramatic, and it's essential. The new combined platform they're building allows a company to monitor these millions of AI agents in real time. And the very millisecond an agent starts to behave erratically.
Like what? What's an example?
Say a financial agent that normally only operates between 9 a.m. and 5 p.m. suddenly tries to access a bank account at 3 a.m. from a server in a different country. Or a legal agent tries to download the entire customer database when it should only be looking at one specific contract.
It breaks its established pattern.
The instant it breaks its pattern, the system can revoke its credentials. Instantly, the kill switch is thrown. The agent is locked out before it can do any damage.
So they are essentially building a real-time police force for the AI agent workforce.
That's a perfect way to put it. The old saying was, the network is the new perimeter. The new reality is that identity is the new perimeter. And by buying CyberArk, which is the undisputed leader in privileged access management, that's the specialized field of managing these super user keys, Palo Alto is making a massive declaration. They're saying, we are going to be the company that governs the new AI workforce.
What's the market impact of a deal this big? It has to send shockwaves through the industry.
Oh, immense pressure on all the competitors.
Yeah.
You look at a standalone identity company like Okta, they handle human identities really well, but they don't have the deep network security and threat intelligence that Palo Alto brings to the table. They're suddenly looking very vulnerable.
And what about CrowdStrike?
CrowdStrike is a huge player in endpoint security, protecting the actual laptops and servers. They are now under enormous pressure from their board and from investors to make a countermove. The chessboard is set for a massive consolidation war in cybersecurity.
And there was a fascinating little detail about the stock listing for this deal, wasn't there? Something about where the new entity is trading.
Yes, I love this part. As part of the deal, Palo Alto is listing on the Tel Aviv Stock Exchange under CyberArk's old ticker symbol, CYBR.
Why?
It's a symbolic nod to CyberArk's Israeli roots. Israel is, pound for pound, the biggest cybersecurity superpower in the world, and this deal just cements that reality. It's a classy move, but it also signals the global nature of this technological arms race.
So we have this incredible story unfolding. The software stocks crash, the bulls say it's a buying opportunity, and the security sector makes a giant consolidation move. But there's another piece to this puzzle we haven't touched on yet. The hardware.
The picks and shovels.
Exactly, because you can't run these trillions of AI agent operations on thin air.
You can't. And this brings us to what analysts are calling the harvest phase and the ongoing CapEx boom.
The spending is it's astronomical.
It's staggering. If you look at the big four hyperscalers, that's Microsoft, Amazon, Google, and Meta, they are projected to spend a combined $650 billion on AI-related capital expenditures in 2026.
$650 billion, that's up from what, around $390 billion in 2025?
That's right. The spending is accelerating dramatically. We are moving out of the early build-out phase and into the utilization phase. But there's a problem right now. There's a major disconnect in the market.
A disconnect between the people selling the shovels and the people who are supposed to be finding the gold.
That's the perfect analogy. The hardware side of the market is absolutely booming. NVIDIA, Broadcom, the server makers, they are the clear winners right now because they're
Yeah,
selling
right.
all the chips, the networking gear, and the infrastructure needed to build these massive AI data centers.
But the software companies, the ones who are supposed to use all this power,
They're lagging. The money is being spent on the infrastructure, but the software companies are still struggling to figure out how to effectively monetize that infrastructure.
they bought all the expensive new toys, but they haven't figured out how to make money with them yet.
Exactly. And you can see this clearly in what's being called the earnings gap.
The earnings gap.
The tech sector as a whole is projected to grow earnings by a whopping 32% in 2026. That sounds incredible, especially compared to the S&P 500, which is projected at around 14%
So tech is crushing it.
on the surface. But if you look under the hood, that growth is being driven almost entirely by the enablers, the chip makers and the cloud providers. The users, the actual software application companies, are seeing much, much slower growth.
So if you're an investor, you're looking at the situation and you're saying to the software companies, you've spent billions on this new platform. Show me the money.
And the software companies are saying, just give us a minute. We're trying to figure out how to price this stuff.
Yeah.
It goes right back to that painful pivot from per-seat licensing to outcome-based pricing that we talked about earlier. That transition is messy, and it takes time.
But there is a big prediction on the horizon. For late 2026 and into 2027, the consumer AI supercycle.
Yes, this is seen as the next major catalyst, the next leg of the stool for this whole revelation.
So what is it?
Right now, most of the powerful AI processing happens in the cloud. It lives in those massive data centers we just talked about. But the prediction is that by late 2026, we're going to see a massive hardware refresh cycle on the consumer side.
You mean new phones, new laptops?
New smartphones, new PCs, new everything, all designed with specialized chips to handle powerful AI processing directly on the device.
And there are some major partnership rumors fueling this prediction.
The big one is the Apple-Google Gemini partnership. The rumor mill is churning that Apple is going to formally partner with Google to deeply integrate the Gemini AI models into the iPhone and iOS. If and when that happens, it could unlock the consumer AI market in a way we haven't even imagined yet.
So the hardware boom might not be over at all. It might just be about to shift from the giant data center to the device in your pocket.
Exactly. And that changes the whole equation all over again. If more of the processing happens locally on your phone, do you need the cloud as much? It's this constant tug of war between the edge and the core.
I want to pivot for a minute. We've been talking about billions of dollars, market caps, AI agents, but I want to talk about the humans, the people actually working these jobs. Because a phrase like death of the seat sounds an awful lot like death of the employee.
The human element, yeah. This is where the rubber really meets the road for most people.
We talked about the efficiency collapse, and that directly implies the death of a certain kind of job, doesn't it? If one manager with an AI can do the work of 10 junior analysts, what happens to those other 9 analysts?
It's the critical question, and the data we're seeing is actually pretty contradictory, which is fascinating.
How so?
On the one hand, yes, there's very real fear of significant job displacement in roles that are repetitive or based on information synthesis. Think legal research, administrative support, entry-level coding, data entry.
The jobs where you're essentially taking data from spreadsheet A and moving it to spreadsheet B.
If that's the core of your job, you should be very concerned. Those roles are definitely at risk.
But you said the data was contradictory, so what's the other side?
The other side is that while those jobs may be shrinking, new jobs are being created at a rapid pace. For example, the latest government data is projecting a 33% increase in the number of information security analyst jobs over the next decade.
33%. That's a huge increase.
It's massive. So in a way, we're firing the doers and hiring the protectors. We're hiring the governors.
We're moving from doers to supervisors.
That's the perfect description. The new high-value human role is governing the fleet of AI agents. If your company now has 100 AI agents running your entire logistics and supply chain, you need a highly skilled human who understands how to manage those agents.
You need someone who can set their goals, monitor their performance, and spot when they're making mistakes.
And you need someone who deeply understands the security risks. You need the human who knows what to do when an agent gets confused or starts to go rogue. The job description is fundamentally changing.
So you're not writing the legal contract anymore. You're managing the fleet of AIs that write 10,000 contracts a day.
Exactly. Humans become the managers and overseers of these new digital fleets.
Which brings us back full circle to the vibe shift in the market. It really feels like we're caught between these two completely opposite narratives.
We are. On one side, you have the get me out sentiment, the panic sellers, the fear. And on the other, you have the this is a generational opportunity crowd.
And it all really comes down to psychology, doesn't it?
It does. There's a critical difference in finance between risk and uncertainty.
What's the difference?
Risk is something you can measure. I can calculate the historical risk of a recession or a market correction. I can build a statistical model around it. Uncertainty is different. Uncertainty is unmeasurable risk.
It's the unknown unknowns.
Precisely. We don't know for sure what the dominant software business model will look like in 5 years. We don't know if the per-seat model completely dies or just evolves. That is uncertainty.
And when investors are faced with true uncertainty,
They sell. They panic. That's what happened in February. They don't know how to model the future, so they just exit the present at any price.
but the smart money, the Dan Iveses of the world, they see things differently.
They look at that uncertainty and they see mispricing. They see a massive emotional overreaction that creates a buying opportunity.
Because eventually that uncertainty will resolve itself. It will become measurable risk again.
Exactly. Once the new business models start to take shape, once we figure out how to properly price and sell these AI agents, the uncertainty will vanish. The market will figure out how to value these companies again, but you have to have the stomach to ride out the chaos until then.
So let's try to wrap this all up. We have covered a huge amount of ground today. It all started with the trigger, Anthropic's release of Claude Cowork.
Which led to the SaaS apocalypse that wiped out nearly $300 billion in market value in 48 hours.
And that created this massive battle in the market between two big ideas, the efficiency collapse theory on one side.
And the rise of the identity fortress and the new security paradigm on the other.
We saw the painful pivot away from per-seat licenses toward outcome-based pricing. We saw the massive industry-defining acquisition of CyberArk by Palo Alto Networks.
And we looked at the future, where humans are less like doers and more like managers of vast AI fleets.
It really is a brave new world taking shape right before our eyes.
No question about it.
And I want to leave our listeners with one final provocative thought, something to chew on as you go about your week.
Go for it.
If software companies stop selling tools for humans to use, and instead they start selling digital workers that do the job themselves, do we, as humans in the workplace, stop being users at all?
That is the billion-dollar question, isn't it?
And if the software itself is now doing the work, does the value of the human in that equation turn strictly into liability management? Are we just there to provide oversight and to push the kill switch when the AI goes off the rails?
It's a sobering thought. But I would argue, if you look at the history of technology, humans have always moved up the value chain.
How so?
We stopped digging ditches by hand and started driving the excavator. Now, we might be about to stop driving the excavator and start managing the fleet of autonomous digging robots. It's the same progression. It's just happening much, much faster this time.
That's a great analogy. So the key takeaway for you listening is to watch those Rule of 40 companies.
Absolutely. Those are the companies that are proving they have the financial strength and the strategic vision to survive this transition from just being a tool maker to becoming an agent builder. The fundamentals still matter.
Thanks for diving deep with us today.
My pleasure. Anytime.